We're news for business people.
Hello and welcome to BloombergQuint. You are watching Hot Money, and these are the top headlines for 12. Indian markets hold on to early gains as traders await second quarter earnings. Adani Transmission and Reliance Infrastructure are in focus. Both of them agree to an exclusive agreement for latter's power business in Mumbai. The US FDA issues a complete response letter to Biocon and Malin on a biosimilar which has been jointly developed to treat cancer. Biocon is strong in trade today. Gujarat government takes a cue from Delhi, cuts local taxes on petrol and diesel. So those were the headlines at 12. Over to Darshan Mehta for Hot Money.
Thank you, Yatin. Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Joining us on the show today is Sangeet Lakkar of Newberry Capital, and he believes that the broader market looks expensive and the rally driven more by liquidity than fundamentals. Vivek Mawani expects a correction over the next few months, and Shahina Mukaddam is bullish on the market for the longer term perspective, but believes that the markets may consolidate in the short term. Today on Hot Stocks, we will discuss stocks like Biocon, Eicher Motors, Fortis Healthcare, JSPL, Max Financial, and IDFC. Let's move on to the first stock, and that is Biocon. The counter is up in trade despite negative news coming in. The target action date for their key drug was missing. The company came out with a response indicating that the US FDA found that the drug was fine, but there were issues as far as their plant was concerned. How does one trade Biocon? What's the view? Let me start with you, Vivek. Do you have any view on Biocon?
No, I don't have a view on that. I don't really track Biocon given my limited understanding of the sector, so I'll reserve my comments at this point of time.
Okay, Sangeet, you seem to be bullish on Biocon. What's the reason for that?
So I feel Biocon is like a lottery ticket.
Okay.
For the two filings, for the two molecules that they have been working on since quite some time, the trastuzumab and the pegfilgrastim. More importantly, both the regulatory authorities, the EU as well as US FDA, has accepted the filings in substance. So they haven't questioned the biosimilar nature of the products.
Sure.
That is important. Both the molecules have a collective size of about $9 billion.
Yeah.
That is massive. So I believe the approvals should come in place next year positively. Second half of next year, and if that comes through, then this stock is up for a massive re-rating.
No, but for trastuzumab, they have already delayed it to December target action date because there were issues as far as their Bangalore plant was concerned. Similar is the case for pegfilgrastim. They had said that it will happen today, but they came out with a response today indicating that the complete response letter has come in. The drug is fine, but there are issues for their Bangalore plant. Now that has 8 FDA observations, 35 French observations. Do you believe that they will be able to overcome these plant issues?
So an important commentary from my perspective is that they haven't questioned the substance of the product.
Okay.
So biosimilars. So I feel that what generics was to patent, biosimilars would be to biotechnology.
Okay.
The total opportunity for biosimilars is close to $61 billion. And that is humongous.
Okay.
And the Biocon was the first players to identify this opportunity way back in early 2000, 2002. From there, they have started spending about 10% of their top line in R&D, and they have been developing a robust pipeline of this product. So I have no reservations in recommending this stock. Even though the current optical valuations looks high, but if any of this molecule gets approved, the stock is in for.
So that's the trigger you're playing for approval for these drugs. Shahina, do you agree with Sangeet, or you have a different view?
Well, I agree with Sangeet on 2 points. One is that they were one of the first ones to start with the biosimilar, the research as well as setting up the plant and machinery. But at the same time, I believe there are issues regarding the launch of this product because it's a very different ballgame than the generics in terms of getting approvals. And as we are seeing the delay that is happening in terms of getting the approval and launching the first product biosimilar in the developed market in the US, and we are seeing this delay happening time over time. I have a neutral view for the stock as of now, because of the second point that Sanjeev made, which I again agree with, is the valuations. I think at the current price, the valuations, even if you look at 2019, you do include some bit of biosimilars that come into the overall revenues and profitability in the next year, then also valuations at 21, 22 times P multiple is on the expensive side versus the larger companies, pharma companies in the space. So I hold a neutral rating as of now.
Vivek, anything you like in the pharma space apart from Biocon?
Well, I would generally refrain from the Indian pharma companies who have issues with US FDA or regulatory and governance related issues. But I'm more focused on the domestic pharma side, the likes of an Alchem, for example, in the mid-cap space, or a Cipla, who have like substantial, in case of Alchem, almost 80% of their revenues and profits come from the domestic market with very minimal presence in the US market. So they don't really have any history of regulatory issues. Cipla is the other bet where again there aren't any regulatory issues that you need to, which are difficult to understand and which creates uncertainty, and a very robust domestic business which generates very high margins and return on capital, return on equity.
Okay, so that's the view that's coming in on Biocon. Vivek is does not track it, but he is bullish on the domestic players like Cipla as well as Alchem. Shaina is rather neutral on Biocon, but Sangeet is very bullish on Biocon. He believes that the opportunity for the two main drugs is humongous. Let's move on to the next stock, and that is Eicher Motors. It's been a marked outperformer. It's down in today's trade. But the big question for Eicher is that whether these premium valuations will sustain or no. It's trading at a PE of in excess of close to 15 times on a trailing basis. But the return ratios are extremely strong. Can this rally continue? It's again a question of growth versus valuation. Shaina, let me come to you first on Eicher Motors. What's your view?
I again hold a neutral view on Eicher Motors. There is nothing wrong with the story, nothing wrong with the stock. You know, even in the worst of times during GST issues as well as demonetization, the company continued showing very strong volume growth. Order book position is strong. The problem I have, which I maintain a neutral stand, is one, it is very expensive versus the competitors, like for example specific Bajaj Auto. So if I was to pick between the two, I would pick Bajaj Auto over Eicher, because if you look at the valuation parameters, you look at EV by EBITDA, you look at EV by sales. On both parameters, it is almost half. I mean, not exactly, but if you calculate in numbers, but it is almost half of at a substantial discount to Bajaj. Bajaj Auto is a substantial discount to Eicher. So, and also if you look at the charts, I think while Eicher has shown a one-way steady up move, so there is no questioning that it is going to continue giving you decent returns. I think Bajaj Auto is likely to outperform. So if I were to pick up one of the two, I would have a neutral on Eicher and a buy on Bajaj Auto.
Vivek, which of the which of the two-wheeler companies do you prefer, and any view on Eicher in particular?
Well, as far as, I mean, first things first, as far as Eicher is concerned, you can't take away credit from the management of having done a terrific job over the last 6-7 years in terms of growth being led by Royal Enfield. I mean, one would have 5 years ago, 7 years ago, when they struck the joint venture with Volvo, one would have expected that the commercial vehicles will be the growth driver, but paradoxically it's been the Royal Enfield which has been the growth driver. You can't take away the credit of the terrific performance month after month in volumes, quarter after quarter in sales and earnings. Valuations is a concern. So while Eicher has had a terrific run over the last 5 to 6 years, let's look at it in perspective. Hero MotoCorp and Bajaj over the last 3 years actually have had some rough period in terms of difficulty in volume growth, margins under pressure, and international markets being difficult, currency issues, especially in case of Bajaj Auto, geopolitical issues. But last couple of months, Bajaj Auto, the volumes seem to be coming back, I mean, with double-digit growth. So has been the case with Hero. If we look at the current year, last 6 months volume growth. So both Hero and Bajaj, although are trading at a significant discount, there's been a reason that their volumes and earnings were lagging. Both of them are now coming from the lows in terms of both margins, in terms of volume growth. All of it is coming back probably with a fairly aggressive pace, and we should see 15 to 18% CAGR in terms of earnings at least over the next 2 to 3 years. Rural economy is reviving and is likely to continue to do well over the next 2-3 years, which benefits both Hero and Bajaj in terms of volumes, which Eicher may not have as much benefit thanks to rural revival. Valuations are more supportive for Hero and Bajaj versus Eicher. And if we believe in the law of statistics, reversion to mean over a period of the cycle always happens. So in case of Eicher, reversion to mean actually would mean a slight derating if there is any slowdown in earnings or volumes. A reversion to mean in case of Bajaj Auto and Hero Honda is actually an uptick both in terms of growth in profits, growth in volumes, uptick in valuations as well. So from a comfort point of view, Hero and Bajaj are definitely preferred than Eicher at the current prices.
Okay, Sangeet, before I come to you, I just wanted to address South Indian Bank numbers. Profit at 4 crores versus 110 crores. That seems odd. I think a large amount of provisioning will be done. 453 crores is the provisioning that they've done. Asset quality seems to be stable, 3.57 versus 3.60. If I see it right in terms of the asset quality, 3.57 versus 3.61. The stock down almost 5% post the numbers. So the earnings season starts with South Indian Bank. The first number is a dud. We've had a big miss on South Indian Bank. Sangeet, back to the discussion. Both Shahina and Sangeet believe that it's expensive, prefer Hero. She prefers Bajaj, Vivek prefers Hero and Bajaj Auto. What's your call on Eicher?
So I agree with both the colleagues. Obviously, Eicher Motor is wrong to be compared with Hero, which is more in the value segment. So talking specific to Eicher Motor, it is like a textbook investment case. You pick up any book on investment and Eicher Motors would qualify for all the parameters except valuations. The ROE is about 40%, humongous growth we have seen, pricing power, completely moated business, and I believe a lot of growth is still there to come. However, valuation is a concern, trading at 50 times. It's now selling close to 60,000 bikes a month, so it's a high base. If you see last few months of sales, the growth has kind of moderated to around 18 to 20%. So I don't see a case for a PE expansion from here on. There could be a case of PE contraction, and also you see a lot of competition also trying to dent Royal Enfield from say maybe a Triumph, which Bajaj Auto has clicked. So I would prefer Bajaj Auto over Eicher based purely on valuations.
Okay, so that's the view that's coming in on Eicher Motor. All the three guests believe that valuation will certainly be an issue for Eicher Motors. Bajaj seems to be the preferred choice among all our guests at this point of time. Let's move on to the next stock, and that is Fortis Healthcare. What's deal or no deal? What's the view ahead for Fortis Healthcare on a standalone basis? Can this company stand? Is there any merit to accumulating the stock? Sangeet, let me start with you. Are you bullish on Fortis Healthcare or no?
I am bullish. I love the business.
Okay.
So if you compare hospital business, so there are largely three peers which are listed. One is Apollo, one is Fortis, and the third is Max India, which is relatively a smaller player. Amongst the operating metrics, Fortis has the best operating metrics amongst all the three. The sales per revenue per bed is about 1.5 crores. They have about 4,600 operating beds, of which about 3,600 they own it by themselves and 1,000 is managed. The important trigger for me is last year they clicked a deal with the Religare Healthcare Trust, wherein they bought back the beds into their book.
Yes.
And which avoided them to pay service fee going forward, which is going to be a huge EPS accretive. Also, the deal which is pending, I think if that goes through, the value unlocking will take place of the diagnostic business. That will be another value added, and I think it is trading at about 25% cheaper to its peer, which is Apollo. Okay. So it gives me a lot of comfort.
So you have valuation comfort there. Shaina, do you agree with Sangeet or you have a different view?
I agree with him. I personally hold the stock, have been holding it for some time. And what I like about it is in terms of the EV per bed. That is lesser than 1.5 crores. So if you set up similar facilities that they have, it's going to be not really possible. So I think in terms of the capability of improving the EBITDA margin as and when occupancy improves, I think is good and is going to see them move into good profitability in the near term, which they already, sometimes they have moved into profits and fallen back into losses. Another thing that I like about it is the debt. They have actually managed to bring down the debt substantially over the last 3 years. And the last point being that the combination of the two businesses that he's already discussed, I think is going to result in value unlocking for the investors who invest at the current levels. So I still have a buy. I would still be a buyer. There are risks. I don't oversee that. At the same time, if you are a buyer, you get the upside in terms of the diagnostic business as and when it demerges, and there I think there's a 30% upside. So I would be a buyer at current.
Okay, so two thumbs up on Fortis. Vivek, do you agree with them or you disagree with them?
Well, actually, I've got a diametrically opposite view relative to my two colleagues, and I have got nothing per se against the business of Fortis per se. I mean, as far as hospitals is concerned, potential value unlocking which could happen sometime in the foreseeable future of the diagnostic business. I've been positive on the diagnostics as a sector. The problems that I have or my concerns that I have are all related with promoter. Too much of negative news flow over the last 1.5 years. Governance issues as far as promoters' misdeeds with group company, Religare, and so on and so forth. Now, typically when there are too many management concerns, governance related concerns, no matter how good the business is, it's very difficult to make money on that particular stock, because the negative sentiment always weighs down everything positive which is there in the business, including the growth or superior return ratios and so on and so forth. That's the one part of it. Connected to this, any business requires growth capital from time to time. Fortis, certainly if it has to have a multiple kind of a growth that from maybe 4,000 or 5,000 beds that currently they have, and over the next 10 years if they need to reach a stage of 25,000 beds managed or owned or whatever the combination one takes, any business requires growth capital. In this case, with so much of negative sentiment, raising external capital by way of any private placement, QIPs is going to be difficult. Promoters are constrained to put in money. So, I mean, at some point of time, this company, maybe not now, maybe sometime in the future, it could be constrained of capital, which eventually affects growth at some point of time. And if it doesn't grow, then there is anyway no case for any investment merit. If there is, if the growth isn't there, the value remains value without growth in a country like India. Yeah. So my negative concerns are more to do with the promoter and constraints that it could have on the ability to invest for future growth. Lastly, deal, no deal. I mean, there's been too much of speculation in the last few months. Multiple potential buyers have been engaging with the promoters for a possible deal. I believe the differences could be on valuation expectations on both sides. Whatever the case may be, right now, all the deals are off the table. At least that's what the public knowledge seems to suggest, unless promoters are doing some backdoor negotiations which the market is not aware of.
Okay, so that's the view that's coming in on Fortis. Shahina and Sangeet are extremely bullish. Vivek says there's no problem with the business as such, but he is concerned with the promoter of the company. That is why he will not touch this counter. Then, before we move on to the next stock, here's a quick recap of all the stocks that we've covered till now. Okay, the next stock is JSPL. The counter was one of the top gainers yesterday after the company decided to divest an oxygen plant. So it seems that the company is on way to restructure the entire business. Is it a good business? What's the way forward? Let me start with you, Sangeet. JSPL, any view?
Yes, I'm extremely bullish on the counter. Obviously, yesterday's deal is a small proportion as compared to the total company. But if you look at the expansion which they have done, so the theme to play in JSPL is they have done a massive capex over the last 4-5 years, which has now come to an end, for which the earnings were depressed in prior quarters, and now which will come to show.
Okay.
So the total capacity now is about 10.5 million tons after the 4 million ton expansion they have done. the JSPL products are very different from what Tata Steel and JSW Steel makes. They are more into long products,
Yes.
which are used for rails and which are pretty much insulated from the import threats. So they would be able to protect their margins. That's what I will assume. That's what the view I would like to assume. Also, if you see the valuation, I expect 7,000 EBITDA for the next year. If I value it even at 6.5 EV to EBITDA, I still get a lot of valuation comfort.
What about you, Shahina?
I agree with Sanjeev. I personally hold the stock, and in addition to the metal business, the steel business, I think the power business is going to be another kicker. There, if you see the last quarter, the PLF was around 43%. It is expected to go up to between say 45 to 50 in the near term, and the management has indicated a target of 60 over the next 1 to 2 years.
Okay.
So I think this is going to be a strong kicker. In addition to the existing better performance in their steel business. So overall, I remain positive. Debt is a very big concern. I think that was the biggest concern that was keeping the stock lower for a long time. And the recent deal that they have done during the last couple of days is a very small part of the overall debt. So I do look forward to the company, working more towards either improving the profitability and EBITDA, which I believe is going to happen, and two is to reduce the debt. And then I think the value would really show up in terms of numbers and the stock price.
Okay, so 2 thumbs up, Vivek. Quickly your view on JSPL.
I'm neutral on it, neutral to positive.
Okay.
I'm also positive, but not extremely positive. 3-4 things after difficult 3-4 years with debt overhang and capital expenditures committed and a steel cycle also not being supportive. It's coming back massively with restructuring, better cost structure, attempts to deleverage. The upcycle in the steel over the last couple of months is also helping them, thanks to what's happening in China, partly thanks to what's happening in China, partly also optimism on revival of global growth itself, raising the overall steel demand. I mean, those are optimistic factors, which JSPL, in terms of getting the timing, it seems to be getting the timing quite right, with additional capacity being available when the steel prices are also more favorable to them, which will help them hopefully better in terms of deleverage much faster and improve the return ratios and so on and so forth. My concern is only that the stock has run up fairly sharply. I'm no expert on commodity cycles, but no, commodity cycles could be fairly notorious both on the, so even in the longer term upcycle, the commodity prices could have fairly sharp corrections, which could have much sharper ramifications for the stock price.
Okay,
so it's more of a trading play than an investment play from my point of view.
Okay, so it's a consensus thumbs up from all our guests. Vivek is saying neutral to bullish, but the other two guests are rather bullish on JSPL. Moving on to the next stock, Max Financial. What's the way ahead now since the deal with HDFC Life has not gone through? Can it be a standalone entity and grow in such a competitive market? Vivek, I'll start with you. Quickly, Max Financial.
Well, I'm positive on it long term. I would say long term it should be a portfolio stock that you love. You actually hold it for over the next 3 to 5 years or maybe 10 years and just forget about it, whether deal or no deal. I mean, even without HDFC, over the last 10, 12 years, Max Financial has grown quite significantly, grown impressively, industry beating growth rates with a very efficient sales organization across all channels, whether it was the tie-up with Axis Bank or their own agency channel and so on and so forth. That's number one. It's also number two. It's a play basically on a greater penetration of financial products, especially the financial security as well as life security. I mean, being a life insurance product. Third, the valuation gives tremendous comfort when we look at the other two biggies who are already listed, SBI Life and ICICI Prudential, both of whom trade in excess of or whereabouts of 4 times embedded value. Max Financial is roughly at about 2.3 or 2.4 times embedded value. Embedded value as of March 17 was whereabouts of 6,000 crores versus the market cap of 16,000 crores currently. So the discount to embedded value combined with faster growth rate, increased market share in terms of new premiums, gives tremendous valuation comfort over a period of time. Possibly the discount could narrow if not fully bridged. I mean, but even if
Do you agree, Shahina, to Vivek?
Absolutely. I think the discount to embedded value offers a good opportunity for getting a better valuation, and I think there is going to be a deal. So
Okay.
it's like not a question of deal or no
It
deal.
depends on
it's-
with whom.
It depends on with whom, and I think that is they're already in talks with somebody else. So we all, I mean, there is market rumors as another large player in the industry, and with 7%, over 7% market share, I think they would get a deal and they would get a good deal. So I would be a buyer.
So 2 thumbs up, Sangeet. Is it a third thumbs up from you?
Yes, there is a third thumbs up
What's
from
the
me.
reason you like Max Financial?
So again, I think majority of the points have been covered by the other guests. But again, it's a perfect play on the financialization of savings theme. It's the 4th largest life insurance company in India with about 9% market share. So my longer term view on the sector would be what you have seen in case of banking, that share from public sector bank have been captured by private sector bank. You should see something similar happening in the insurance space also, wherein the private sector insurance companies should take some share from the LIC,
Okay.
and which is happening. So right now the private sector are commanding about 56% of the total market, and which is growing.
Okay, so 3 thumbs up from for Max Financial. We are running out of time, so we'll take the last stock, and that is IDFC. What happens with the deal synergies now? Sangeet, I'll start with you only very quickly, 1 minute. IDFC, your view.
I am neutral to the stock. I feel the stock is fairly valued at the current price, looking at the holding company discount. If the deal goes through, it's negative for the IDFC shareholders, though it could be positive for IDFC bank shareholders.
Okay.
But as far as IDFC is concerned, because of the discount which will accrue, it's going to be negative.
Shahina, your view on IDFC?
Yes, I'm also I'm neutral to negative on the stock, neutral largely, basically because I think first of all we are not going to know the outcome of this till November.
Sure.
So there's a long way, and secondly I think valuations. So I would just avoid this.
You would avoid it, Vivek?
Yeah.
Your final view on IDFC?
Even I'm absolutely negative on IDFC. I mean, there are multiple things. One is whether deal or no deal. Firstly, the deal timeline has been extended, which probably raises doubts whether the deal possibly may not go through. But assuming it does go through, like any large and complex mergers take time to consummate. Most of the time, 9 out of 10 times, the merger related efficiency and synergies never materialize, but in that whole process it's the investors who lose out because the stock stays range bound. It's difficult to really make money on that kind of a scenario of too much of uncertainty, number one. Number two, IDFC itself has been an underperformer when it comes to growth in its revenues or earnings, or whether balance sheet related issues in terms of NPAs and so on and so forth. So whether the deal happens or doesn't happen, even standalone IDFC, it's not that it has had a terrific performance that one can really bank on. There really is no case for me to make as to why I would buy IDFC. Where, I mean, the valuations don't give comfort, the business doesn't give me comfort, the merger doesn't give me comfort.
Okay.
So then what is really there to be looking forward to in terms of positivity?
So that
best, the stock may just stay range bound and do nothing.
So that's the view that's coming in on IDFC. None of our guests are actually rather bullish on IDFC. Sangeet and Shahina are neutral. Vivek is negative on IDFC. Before we wrap up on the show, here's a quick recap of all the stocks that we've covered on the show. Vivek, Shahina, Sangeet, thank you so much for joining us on the show. With that, it's a wrap on Hot Money. Thanks for watching BloombergQuint.